right, let's get it going. It's Friday. Thank God it's Friday. We're here. We're Wall Street Beats. My name is Benjamin Bry, joined with Robert Marson and Kevin Bakes Baker. We're going to start it off with an out of favor name, similar to what I was talking about out of favor yesterday with my fellow out of favor enthusiast, Robert Marson. Let's get it going, buddy.
Yes. Down, too cheap to be true, and still squeaking out low to mid single digit revenue growth is apparel company American Eagle. AEO's the ticker. I bought a starter position yesterday at around, maybe Wednesday at $17. It's not much higher than 17. I think the range is like 15 to 26 or 29. So it's down a lot. It hit my new buy screen. When a high quality company hits my new buy screen, I should buy it without question and then investigate, because I've missed a lot of names that I've rationalized off that buy screen for being shitty companies or some other reason, and made some major mistakes by not buying them. So the default is to buy these things and then get real or get big or get out if you don't want to follow through. So the stock is, flat. Yes, the bull market of the last 10 years. If we could put up a 10-year chart, would be amazing. But, it's 4 times EBITDA. It's 10 times earnings. It's 60% of sales. A power company was bought that was a total certified POS yesterday called Vince at 70% of sales and 15 or 20 times EBITDA. So this is a company that thinks it's smart and it's not really. The management is a little stale. The product is fine, if not growing, in the core business, which is American Eagle, denim heavy product. And I wear their jeans and I like them. My daughter wears their jeans and she likes them. She's 30. I don't have any teenagers in the household to pull, but the real driver of this company is not American Eagle. It's a brand called Aerie. And it started with intimates and swimwear, has branched out into casual wear and fleece and some other areas. And while American Eagle, the brand, is $3 billion and change today and was $3 billion 10 years ago, Aerie was $300 million, I think, about 8 years ago, and today is closer to $2 billion in 2025. So that if that were a standalone brand, it would probably trade at 20 or 25 times earnings, not 10. And, it's responsible for about 40% of the sales and 40%, maybe more of the profits, because I think the operating margins are higher than the American Eagle brand. So it might even be 50% of the profits. So stocks like this, Ben, there's not a lot of excitement when they get down and get cheap. They last quarter, they made the numbers, but guided down a few pennies. So the stock, got whacked because of that. People are just tired. They're buying, Abercrombie and Fitch, which is killing it, and selling American Eagle. They're even buying Gap, which is, has been a terrible brand for 10 years or so. So you can get a takeover here. You could get an activist here. You can get a growth spurt in a new category here. If they ever put up 10% sales growth in one quarter, year over year, in the next year or two, the stock will double, because it's so stupidly cheap at 60% of sales and 4 times cash flow. No debt on the balance sheet, net cash. They do have $1 billion in lease obligations. That's down from the top, and they are managing that much more aggressively than they ever have to lower costs there. And their goal is to grow 3 to 5% a year in revenue and squeak out 8 to 10% earnings growth. They say they are under earning 8% operating margin last year, 7 the year before, and they're shooting for 10. So not only are they cheap, but they're under earning according to the self-proclaimed world-class management team at American Eagle.
That self-proclaimed world-class management, I know one of the pushbacks here would be that they're not world class. And what do you think about that? Is that I view that as like, hey, maybe it's a positive, because you got to change.
Absolutely.
Yeah, they can go. Exactly. Like,
absolutely, it's a positive. It could be an
what
activist that changes, or they could just figure it out that they suck. A guy like me can write a letter to the board, questioning their intellectual capacity for maintaining this management team for so long.
You should start the letter like that. Like, I'm questioning your intellectual capacity. See how that goes over.
Read,
How the
read on,
cop
I would say to me. I mean, give me more. Tell me more. Hey, Robert,
how the cop
you you said this when a high quality company comes down to this level or hits your buy screen, and I'm being very sincere here. I hear self-proclaimed brilliant management, and you don't think they are. Give me the definition of high quality that makes you look at this, please.
I didn't say there's any high quality about any aspect of this business. It's a
I could have sworn you said.
Solid brand. It's a solid brand. Aries high quality with its growth rate and operating margins, and that's the smaller division of the two. But management is the opposite of high quality, and the company's growth rate is low quality, and their profitability is low quality. And so that means there's opportunities for change from either an activist or an LBO bid led by management or a hostile bid led by someone else. There are private equity firms that scoop up and fix, struggling retail and apparel brands. I don't know them, but they bought, one of them bought Vince yesterday, which was a terrible retail apparel company.
In this last 20 years of dead money, has anybody made a run at them? Have they gone private before, or has anybody made a run at them? Or
not that I know of.
Okay.
And now I have to look in to see if there's a super vote. I looked at it and I couldn't find it, but I have to talk to the company and confirm there's no super vote. Because I think all of management owns about 10% of the stock, a little less. So they can't their economic ownership it could not preclude a hostile takeover, I believe. But if they have a super vote, then perhaps a 10-1 vote, then perhaps they control the vote. I do not know. I will look into that and get back to. If you subscribe, you'll find the answer in a future posting.
Oh, you tease you.
You'll find an answer on the real chat.
One last thing. How have the comps been the last couple quarters?
Low single digits, which is kind of positive. What they're. Low single digits. 0, 1, 1, 2, that kind of stuff. That's how they're not putting up a lot of square footage the last couple of years. This year, they are going to grow more in new store openings. They're doing remodels that they're raving about the results. In fact, they said they did one in the King of Prussia Mall next to me, and it was like some crazy number of incremental revenue growth, 20 or 30% for American Eagle. So I have to go visit that store and maybe buy myself a new pair of jeans and check it out.
That's the greatest mall in America, by the way, in my opinion.
It is. When you look, I'm not arguing. I'm just smiling.
Everybody knows what opinions are like.
I think the specialty apparel. When I first started my career, I covered some specialty apparel, and these stocks can they're very cyclical, right? They get in favor. They catch a product right, they rip for a year, let's say 3 to 6 quarters, and then the comps get tough and then they roll over. And if you look at American Eagle's stock chart, that's exactly what it looks like. It's had some moments and then it's had some bad moments, right?
Yeah, Ben, I did the same thing with Abercrombie and Fitch 2 years ago and concluded it was just another piece of dog do and passed on it. And it was 25 and it hit 200 in 2 years. So they caught a problem and had some excellent growth. And at some point, if we get lucky, I wouldn't prefer any kind of deal here at a 3% premium. That would be my least favorite outcome. I would like to hold this for 8 quarters and have 2 or 3 of them be some new product cycle that takes off, or new denims fad that takes off and creates 10 or 15% revenue growth for a period of time with that product cycle success, and watch the momentum investors and the cheap growth buyers bid this up 100 or 200%.
Yeah.
Robert, go ahead. Robert, do you have any thoughts on Abercrombie? Because I was told that Abercrombie was ripping it, and it's been obviously a huge stock. This is Abercrombie and Fitch now, but I mean, this is ominous. This is rolling over, and it isn't. If it was just one report and we'll give them a pass, but now it's 7 out of the last 8 trading days, And this is just taken on water. And I don't really know why it's as persistent as it is. But if you have thoughts, I'm all ears.
I do. It's on my watch list. ANF is, because when you put that longer term chart, you can see there's a lot of air in underneath that stock, and if it breaks down, because they have a bad, they're clearly over earning on their operating margin. Fundamentally, when 2 years ago they were doing a 5% margin, they aspired to 10 in print in an analyst day, and they did 15. So, and they've never done 15 in their history. So one has to wonder if the earnings are not 30% over trend, and that there's a big, normalization in a year or two at some point. So if that happens, and the stock could just get clobbered, because the $9 number might be 6 or 7, and at that point the stock goes to 70, then you buy the heck out of it. But because it fits my profit-taking panic theory. So there's a lot of people with a lot of profit with a bad-looking chart that starts to break down. Watch out below when that happens, especially if they miss. The stock's cheap enough to own for a trade if they keep doing well, and they're doing well. But they have very difficult comps because their period of growth be under their belt in the last year and 2 years was so exceptionally high for an apparel.
Yeah.
Thank you.
I think it's interesting. I mean, like, I like things that are out of favor that have, and look, it's like you said, the fundamentals aren't bad. We're not talking about something that's like Dave and Buster's, which is consistently doing, mid-single digit negative comps. But yeah, I mean, they have leases, so it's not really debt free, but that's an operating cost. And if they hit on a cycle, it can be a good stock. These things, that's just how they work. And Abercrombie was a great example of that. That was left for dead. No one thought about Abercrombie and Fitch, and that was one of the best stocks of the last 18 months. Now, recently, they since ICR, they gotten a little dinged, but it wasn't that because their business was bad. It's just expectations got too high. Like Jeff and Berna, our partners here, would tell you, like, they had a good sales guide. It's just the margins weren't there. So, these things can work.
I agree, which is why I bought stock this week. So I'm not pounding the table. I have two categories of stock, Kevin, that fit my buy model. One is down. They're all down and too cheap. One has growth story that missed the growth, but still has secular growth. Those are the ones I want to get excited about. The ones that are not supposed to grow or grow 3%, 5%, I'm not, I buy them because I could get a 50 or 100% trade out of them when they get to 4 times cash flow. Because I'll be frank, nothing trades at 4 times cash flow. The market is telling us that the cash flow is going to be negative in a future period. Every stock, the stock market trades at 15 or 13, 14, 15 today, somewhere in that range. Nothing trades at 4 times. If it does, it gets bought out by a financial buyer. So the market's telling you cash flow is going to drop here. And they say they're under earning and their operating margin and target is 10% versus 8%. So if they hit that operating margin target and grow, the stock has to go up. But it's not going to become an exciting growth idea like when I bought Chart Industries after it went from 180 to 110 and the chart was crap. Now it's 220 and it's less. It's probably halfway to long term only. So I got to wait 6 more months to even book some profits in that. And it's got a growth story. They're growing revenue 15%. This company could do that if they had a product cycle that really kicked off, but they're going to grow mid-single digits probably only ever,
And that can work. That can be okay. I mean, what do they do? Like, what's the free cash flow yield on this roughly?
Over 10%, Ben.
Yeah. So that checks the box. What are they doing with the capital? Are they just buying back stock?
Yeah, they pay a decent dividend and they have a decent buyback. Yep.
Yeah, so look, that's the kind of things you want. You want, like, hey, like I own Match.com and there's not much growth there, but it's like a 10, 11% free cash flow yield. They're aggressively buying back stock and they don't have debt and all those kind of things. Like, it just takes one thing to go right and these things can work. And in the meantime, it's not like you owning a cash burning business that's, you have the clock against you where you're losing money every day you hold it, and it's an eroding option. So I don't know. I like it. I think it's good. All right, Kevin, what do you got today? What's got you over there in the technical land? You excited?
Yeah, well, yeah, I'm all over the place right now. And I just put up for, because I want to make sure that folks that are new to Robert don't get lulled into, here's this stock that's down and wake me up when September ends. Because what happens is he, tends to get on these things and he's early. And he has a patience that I don't have. My middle name isn't Job. But here's, Chart Industries, which was the same kind of thing, hit his buy screen and just kind of slugged it out. And the next thing you get doubles here. And these are not sexy stories, but doubles are sexy stories to me, and here's Select Water Solutions, about the only good looking thing in energy service right now. So for members and prospective members, don't let Robert's more than a pretty face. He actually picks some stocks that do go up, and you just got to be around for when the initial buy might elicit yawns. So there we go. Anyway, this is going to be a little bit unorthodox, but I can't help myself. It partly is I'm recovering from surgery, and I'm listening to podcast after podcast and CNBC pundit after CNBC pundit, and I've got all of them telling me, there's this default mechanism where, as Warren Buffett says, your old stocks for the long term, and the Buffett indicator is at 130. And frankly, that's like the CAPE ratio. I mean, I Citi at 50% of book value. After a while, you cry wolf so much, I just don't care. And I just picked this up as another example. And I'm not bashing Buffett. The guy's a genius, but I don't like people presenting themselves as if they play a bridge with Buffett on Tuesday. Buffett's Buffett, you're you, and there's nothing in the middle. And I just pick on this for a little bit because this is another example. Oh, well, Buffett owns Oxy. Well, okay, Buffett owns Oxy. It's been dead money for 5 years. It has. Okay, obviously this is an extreme. I get it. But even over the last, there's been no money made here. And so I just have, and part of this comes from the fact that I had a great conversation with Paul Meek's investing class, his student managed investment fund, which I love doing this stuff. Talking to 22-year-olds, it is an absolute blast, especially when I get to come in with my heretical technical analysis on top of their canonical fundamental analysis. Kind of made those up, but you get the idea. But here's Oxy. My point being is as soon as someone says, hey, I'm going to follow Buffett, be like Buffett, I would literally walk away. I don't think there's any money to be made there. You're not 92. You don't have his job security. You don't have an insurance structure. You don't have a balance sheet that's a fortress. You don't have his time frame. And I just think it's a recipe for holding dead stocks. So to my younger viewers out there and our younger members, I would just say, Buffett's great. Listen to him, I guess, but don't follow him. It just doesn't make any sense at all. I've never seen anybody make any money echoing his sentiment. That's just me.
Oh, Banksy, I tweeted when he bought the stock. It was way too late. He was being lauded for, taking advantage of the COVID crash. And yet oil had gone up 5 times and Oxy had gone up 6 times or 4 times off the bottom before he bought it. And I tweeted that it would be a push as a long-term investment. And 5 years later, that turned out to be spot on. Good for me.
Okay, good for you. I admit that one I missed. And I throw you flowers,
No, but I'm just saying it was to anybody in the business. It was obvious he was trend following after oil had gone up. And that's the worst thing you want to do, in my opinion. You only buy oil stocks after oil goes down, and you sell them after oil goes up, period.
And my vantage point is I started getting into this because I wanted to teach my boys, because who are now 28 and 26, what's obvious to us after doing this for 30 years and the battle scars we've earned is not obvious to the average investor. who is not immersed in this and reading Barron's cover to cover every weekend and going through 4,400 charts. And so I like to point out, hey, this is the way the CNBCs operate. They're there to make their advertisers money. They are not there to make you money. And then I get on this show, which, I'll put up any half hour we do versus any half hour they do, and we make money. I mean, week after week we're the CNBC that makes money, and it's obvious to me. And I just like to point out some of the Wall Street traps that are out there so that my sons in particular and people like Paul Meek's students don't fall into them. You'll make new mistakes, don't make the same ones twice, and don't make mine. All right. My diatribe is over, I think. I might delve into another one. Anyway, I thought Mackie was going to be on, but it doesn't matter. Lulu. And what I do is anytime we talk either on the show or offline, I add anything we talk about to my database. And so I'm literally going through every single chart we've talked about every single day. And this is a pretty chart. And what really caught my eye here was this 200-day moving average is just starting to turn around. Now, this is Robert territory, okay? And this is Bake's territory up here. The 200-day is just turning up. The relative strength is improving to 84. This is a beautiful base between 366 and 395. Sorry, 366.95 and 420. And that to me looks like another stair in a staircase that's getting ready to be built again and hopefully turn into some shadow of what Lulu used to be, which is a pretty damn good stock. So Lulu's look intriguing to me. I'll let my fundamental retail brethren and sisters opine on that, but it looks pretty interesting to me.
I did look at it at the bottom, by the way, and it was relatively cheap, but not absolutely cheap for me, so I passed.
Okay. Last but not least, and I love the Who, as you guys have probably figured out by now, but TKO Holdings, I remember throwing punches around and preaching from my chair. Pete Townsend, who are you? And this is TKO, and I think we talked about this, back here during this gap down, if I recall correctly. And I'll reach out to Mackie, and I hope he sees this to opine on that. And I forget what the bad news was. It was a miss. It was, frankly, I forget what it was. And frankly, we weren't that concerned because it spent all this time. It didn't even come close to the 200-day. It just kind of said, all right, we'll take the hit and then we'll keep going. And then here we are today. Yesterday was 121% of average volume. Today's 46% above average volume, new highs, and just an absolute thing of beauty. So TKO, Jeff, I hope you're still there. I hope you're still listening. And it looks like a stock that continues to go north.
Yeah, he told me he liked that. He thought that the results from Netflix were positive for them for just proving out live sports on streaming and all that. And they would be a big winner. And that stock chart looks good. Not to, it doesn't take like a technical genius to say, oh, that's a good looking stock chart. The last thing I'd say is I've been a big proponent of gold for a long time, and we are now at the all-time highs this morning and looking good. The case for gold's probably never been stronger, and I continue to like it here. Just as one last little closing bit. All right, so that's about all we got. We got American Eagle. If you're interested in more details from it and Robert's note, come check us out. Kevin giving us a little bit of flavor on the charts, and my, every once in a month reminder, buy some gold. All right, guys, that's what we'll call it here. And have a nice weekend. And this is Wall Street Beats. Take care.
Take care, folks.
Go get them, guys.
Book them, Dano.